Hello everyone, welcome to the week 4 live session of our course on corporate finance. I hope my screen is visible to everyone. Okay, fantastic. So let's start this week. So in week 4, the broad topics which were covered in week 4 was like first topic was the maturity and duration, like how we compute the maturities of different cash flows or and the duration and what is the difference between them. Then we move to some macroeconomic or economy-wide measures which affect the overall economy and also the financial markets. So first such measure was the inflation. Inflation is like which we see in day-to-day life also, like how the prices are changing. And it is a very important rate which we should consider, like we have seen in week 2 also, like when we were discussing the intertemporal budget constraint, there was like a role inflation was playing. And also if you deep dive in the financial markets or financial economics, then you will see like inflation is the one of the key parameter. And later in the week 4 lectures, there was a discussion on yield curve. So yield curve is particularly related to the bond market. It relates like the analyzed returns of bonds according to their maturities. So that is the yield curve, and we will have a quick recap like how these things play a role and how do we measure that. Okay. Okay. So first, like what is maturity? Maturity is the most simple measure of like when will I get my money back. So maturity, if I have cash flow, like for example a bond or something else, if you invest in a project, etc., etc. So maturity is simply the time when you like the from today till the time last time when will you be getting your last payment. Okay, so how much time remaining for your last payment, that will be your maturity. So for example, if there is a bond which pays its last amount up after 30 years, so it is a third, so its maturity will be 30 years. When is it does not matter what is the payment value, etc. Only the when the last payment is being made, that matters for the maturity. So we see like in maturity the amount which I am getting, that does not matter. So when we compute the duration, which is then another measure, like when I am getting my money back. So if we incorporate like how much I am getting on a certain time, then we get a new measure which we call the duration. So duration is the payment weighted average of all payout times. So in this what we do, so at each time when I'm getting some payment, and in that payment, like I will be getting some payment like value of that payment that I have. So if I denote that value by ct is the cash flow at time t or payment at time t. And if I compute this weighted average, so if I multiply this payment to the time, so this time may be in years, months, days, etc. So if I do this and if I take this weighted average, it will give me a measure, and that we call the duration. So duration denotes like my, it also incorporates the payment which I will be getting at that time and the when I am getting that payment. And later a new modified version of this duration was introduced, which we call the Macaulay duration. And in this, like instead of waiting by simple payment, we wait these time these times by the present value of those payments. And this is like the most refined version of duration, and this is the most refined measure of like when I will be getting my money back. Okay, so in Macaulay duration, we just simply we wait the times by the present value of the case payments which I am getting at the time. As simple as that. Okay, fantastic. So let's take an example of like measuring these like maturity and durations. So for like the question says like there is a bond, its current price is 900 rupees, and this bond promises to pay you 250 rupees after 5 years, 500 rupees after 10 years, and 750 rupees after 15 years. So there are three payments which you are getting. I am taking a very simple example, and the prevailing discount rate is 5% per year. And the question asks like what is the maturity, duration, and the Macaulay duration, which we learned in the previous slide. So maturity is very simple. Like you are getting your like the last payment after 50 years, so your maturity is 15 years. Very simple. So for duration, what we do like we compute the like the weight each like when I'm getting my payment, I wait the time with the payment which I am taking. So I will wait 5 years with 250, 10 years with 50, and 15 years with 750, and then I will take the weighted average. So if I do that, so this is the calculation of my duration. So 250 times 5 plus 500 times 10 plus 750 times 15 divided by the total sum of my payments, 250 plus 500 plus 750, that is 1500. And if I do this calculation, I get my duration in I get my duration to be equal to 11.67 years. So it is saying like I am getting all my money, all the payments which I will be getting in 11.67 years. Now here we have taken the normal values of nominal values of the payments, like which I am getting at that time. But in Macaulay duration, what we do, we take the present values. So each payment is converted into its present value. So 250 is converted in its present value, like by dividing by 1 plus 5%, and it is I am getting it by after 5 years, so I will discount it for 5 times. Then similarly, I will compute the present value of the other two payments also, and I will compute the weighted average based on those present values, and I get the Macaulay duration to be equal to 10.93 years. So it is roughly like 10 years and 11 months. So what Macaulay duration says, like if I consider all my payments in today's terms, then like roughly in 11 years, I will be getting all of my payments. And you can compute like your like you can sum these payments, and you can know you can sum all these values, and you can say like this is the total amount I am getting, and roughly in 11 years I will be getting all my money back in if I compare it with the present values. So that is the illustration of these maturity and durations. And if you have any questions on that, how do we calculate that and any other aspect, please let me know. Fantastic. So
Sir,
yeah,
sir, for the Macaulay duration, what in the denominator that 1.05, why are we taking that?
because in Macaulay duration we take the present values of the payments, not the nominal value. So I am getting, let's suppose this 250 rupees I am getting after 5 years. So what will be the present value of those 250 rupees? So I have to discount that with the prevailing discount rate, that is 5% given here. So we calculate the present values of all the payments, and we weight all the time durations according to that.
Sir, actually, this 5 year, the exponential that is 1.05 to the power 5, 10, 15, that I can understand that it is for 5 years, 10 years, and 15 years.
Yes,
But why that 1.05? Is it because of the interest rate?
yes. So how do we do discounting for any payment which I am getting in the future? So we discount it in the form like so. So first one is like 1 plus r, its power the time when I am getting the payment. So it should be 1 plus 5% to the power 5 in the first case for the 250 rupees payment, correct? So that is I have done.
Okay, sir. That is that 1 plus 5 by 100 to the power 5. So
Correct.
those are coming as 1.05. Thank you,
Correct.
sir.
Correct. Okay.
Sir, in this 900 is nowhere coming in calculations. Is that the one which is final value after 11.67 years, or?
I think there is a typo, like it should be 306.96. I think there is a typo in this thing. No? I will correct it like once when I will be sharing this with you, I will correct this typo.
Oh, this 906.96 is actually 900.
No, I think, sir, it is 306.
Yeah, it is 306.96. There is a typo, like I have mistyped this value.
Actually, my question is not that, sir. The current price of 900 is there, no? That is nowhere figuring in any of these calculations. Maybe is my understanding wrong, or is that 900 is the value of the bond
No.
or?
Now, the price of the bond will not play any role in calculating this maturity or durations. Only the
Oh,
future cash flows which we are getting, those matter for like these calculations. Okay.
okay,
Yeah.
okay, okay.
Okay. So moving forward, the next topics which were covered was the inflation. So what is inflation? Inflation is, in layman terms, it is the change in price level. So what was the prices in the previous period and what is today, and we take the percentage difference and we call that like this is the inflation rate that is prevailing in the economy. But how do we get this price level or the price index which we say? So we need to, because in an economy there are multiple goods which are being purchased and sold. So we need to get a like uniform price index which we can use to calculate this like very useful measure, correct? So for that, like there are multiple price index which are there, but majorly like consumer price index, wholesale price index, and GDP deflator. These are the three main price index which are used to measure this inflation on an economy wide level. Okay, so in the lectures we mainly focus on this consumer price index and GDP deflator, and because the inflation values which we see in the newspapers or in different headlines, those are coming from this consumer price index only. So this how this consumer price index is computed. So for that, what the regulators or the policymakers do, they fix a consumption basket and they observe the price changes of this basket, like the all the products which are there in this basket. They observe the price changes and then they compute this inflation value. And this basket is, they make this basket to be very representative of the population which they are focusing on. So for example, in India, the RBI or the mostly which is the Ministry of Statistics, like the which is responsible for calculating this measure, they compute two types of measure, one for urban population, one for rural population, and then they give a combined economy wide value, correct? So for example, like this is an example, like for this is the example for India. So in there are two baskets, one for urban population, one for rural population, and these are the weights which are given to each of these categories. And if you go to the Reserve Bank of India's website, you can find like all the items which are there in these respective categories. Like in food and beverages, you can find there are multiple items there. In house, like in clothing, footwear, also like in all these categories, you can find all the items which are considered for calculating this consumer price index. And these weights, they do not change very regularly, like they take a base year. Like for example, these are the weights considered a code, like these are weights fixed in 2012, so they do not change like until they change the base year. Okay, so if you have any concerns or any doubts regarding like how this CPI is being measured, so please do let me know, like I will explain, I can explain more. So once, like for example, once we have these weights defined for each of the, like for different items, then, and if we have like the prices for these items, for example, if I consider each category as a item in this basket, for example, my basket has 6 items as of now, and these are the 6 items, and I have the prices in 2012 and 2013. So if I want to compute like what is the inflation in 2013 in comparison, like the annual inflation that is there, like in comparison to the 2012. So I am considering 2012 as base year. So the whatever the combined price value that will be coming, I will be like the converting it to like the, it is base year, so I will convert it to the 100, and accordingly I will compute the CPI for the subsequent years. Okay, so how do we calculate this? So I have these weights with me, I have these prices, so I can compute the overall price of my basket in 2012. So I can compute the overall prices in 2012, that comes out to be 3436.07 rupees. And because this 2012 I am taking this as a base year, so I will normalize this value to 100. So what I do, like I will convert this value to 100, and similarly I will compute the overall price of my this consumption basket in 2013, and similarly like in the subsequent years also, like 14, 15, 16, I can compute the price of my basket, and then I will like convert it in the 2012 terms, like because I am taking 2012 as my base year, so I can compute the CPI in 2013, and that comes out to be 118.61. And once I get these CPI values, I can compute the inflation simply by taking like the current year's CPI value minus the previous year's CPI value divided by the previous year's CPI value, and in given if these were the prices, then my inflation in 2013 is 18.61%. So if you go to the RBI website, they provide monthly CPI data to you, like for each month what is the CPI values, and they provide these values like the cumulative value, also the category wise values also, so you can see like what are the different price levels, and they also give you the inflation rates also, and you can also compute the inflation rates using this formula also. Okay, so now in CPI, like what we do in CPI, we have fixed a consumption basket, so we are not considering all the goods and goods, products and services which are there in the economy. So for that, like a different measure which we call the GDP deflator, so that is also a type of price index, and that can be used to compute the inflation. So what is a GDP deflator? Before understanding that, we should know like what is GDP. GDP is the total market value of the goods, with like the final goods and services produced in an economy during a given period. So for example, what is the GDP of India in 2024? So you, like the authorities will come do this calculation, they give you this measure. Okay, so we are not going in deep diving in this concept as of now, but this is the concept of GDP. And when you see the GDP numbers, there are two types of GDP values which are given to you. One is like at the current prices level, and other is like the constant prices level. So current prices GDP, which we call the nominal GDP. Okay, and if we use, like, if we assume that prices are same, if we are only tracking the change in the number of goods and services only, then we see, like, if we fix the prices to some base year and we measure the value of final production, that we call the real GDP. Okay, so if we take the ratio of this nominal GDP to real GDP, then that will give me a measure of, like, how the overall prices in the economy has changed. And this is how we get the GDP deflator, and it represents the overall price level in the economy. Okay, so this is the primary difference in GDP deflator and consumer price index. And the common norm is like the normal inflation values which we see in news or the newspapers, etc. Those are the CPI inflation values, and because those are more relevant to a particular consumer, because a common consumer is not consuming all the goods and services that are produced in the economy. He is consuming a, like, from a basket only. That's why. Okay. Okay. So similar to the GDP values, there are, in the interest rate environment also, there may be, like, there are two types of interest rates which we can have. One is the nominal interest rate and other is the real interest rate. So nominal interest rate is the interest rate if we consider in terms of currencies, like the change in the prices or the value, overall value of a good or a product or a asset. And the real interest rate is if we think in terms of the change in the number of goods or number of assets only. And what is the relation between this nominal and real interest rates? And that is, like, the given in this form, and in the, I think in the lectures professor do some derivation of this relation also, if I remember correctly. So the relation is like the real interest rate, 1 plus real interest rate is equal to 1 plus nominal interest rate divided by 1 plus expected inflation in the next period. Okay, and if these rates are small enough, then we can use this approximation. And why, like, when to use this approximation and when not to, like, for example, like, if interest rates are very small, then we can use this approximation. For example, like, if interest rates are very small, 4%, and inflation is 2%, so using the actual relation, we get the real rate of interest to be 1.96% in this case, and through approximation we get 2%, and which is, like, more or less similar. There is very less error margin, but at the same time, if these interest rates are very high, so you can see, like, this difference is very high, and that matters a lot. So until unless it is not said explicitly that use the approximate formula, you should always use the exact formula or exact relation between real and nominal interest rates. Okay, any other questions or any other clarification if you need regarding inflation or GDP deflator or CPI, etc., please do let me know. Okay. And the third topic which was covered was the yield curve. So what do we mean by yield curve? So yield curve is nothing but, like, it shows the relation between the interest rate against the maturity. So annualized interest rate of the bond versus the maturity of the bond. Okay, and in general, like the normal yield curve which we see, like it is a upward sloping. So that means like the interest rate on the longer term bonds is higher than the shorter term bonds, and the difference between these two is called the term premium. And why in general it is higher? Because as we delay our, like the longer we wait for our payments, the higher the risk that the economic environment may change, so we are taking more risk, so in turn we expect a higher return in that sense. So in normal times this relation holds, but it may change in adverse environments, and that is like the that is that can be observed in these yield curves at different time periods also. Okay, and you can see these values like for the government bonds. So for example, this is the data from RBI. So RBI provides weekly data on different government bonds. So the government bonds which are less than 1 year maturity, those are called treasury bills, and those are above, those are called the government securities above 1 year. So this is the data, so which I have taken from the RBI website. So it gives me weekly data for 91-day treasury bill, 182-day, and 364. So this is 3 months, 6 months, and 1 year, and then 10-year government bonds. So through this, I can have a representative yield curve from this. And why this yield curve is important? So using these yield curve data, what we can do, like we can compute the forward interest rates also. So how do we do that? Let's take an example. So I will be using the values for 3rd October, like the last week's data only, to compute these rates. Okay, so for example, if the question says like what will be the return on a 3-month investment in 90-day treasury bill. So please note these yield rates or interest rate, whatever we say, like these are given in the annualized form. So if you hold a 90, so if you hold this asset for 1 year, then this is the return which you will be getting. Okay, so now the question asks like, so if you purchase a 3-month treasury bill, okay, then what will be the total return which you will be getting? So what we have to do, like we have to convert the interest rate, like that was the annualized interest rate. So what will be the interest which you will be getting for 3 months? So this is how we get, like for 3 months we have to change the time value to 1/4, because in a year there are 4 quarters. So the total interest which you will be getting, or the return which you will be getting on a 3-month investment in this 91-day treasury bill, that will be like approximately 1.345%. Okay, and given the previous tables 10-year government bond annual return data, so on 3rd October this 10-year government bond return annualized rate of return was 6.47%. So if I do a investment on government 10-year government bond on 3rd October, then in 10 years what will be my overall, like the total holding rate of return? So if I hold this government bond for 10 years, then what will be my total accumulated return? So that I can calculate by like the total holding period rate of return formula, and through that what I get, like the, if I hold this government bond for 10 years, then total return which I will be getting in 10 years, that is like approximately 87.19%. Okay, this is how like we can use the values which are given in the on the yield curves. And how can we use this to compute the forward rates? So you see, like we have the current data only. So I have 1-year bond data, like 10-year bond data. So in between there are multiple maturities also available, like 2 years, 5 years, different maturities, 20 years, 30 years, all maturities data is available. So but I have not shown here. like RBI, I was unable to find it first. So I have taken this like 1 year bond data and 10-year bond data, and I assume like there is a straight line yield curve for that, and from that I can compute like for each maturity for 2 years, 3 years, 5 years, whichever maturity I want. I can, by doing this interpolation, I can get this interest rate for different maturities. Okay. Using those rates, I can compute the forward rate. So for example, if this question asks like 1 year interest rate from 3rd October 26 to 3rd October 27. So for example, like it is asking me to compute like if I purchase a bond on next year's 3rd October, and if my assumption is the conditions are not changing, then what will be the interest rate that I will be getting in this situation. Okay. So as I have said, like my assumption I have stated here also, like I have considered a straight line between 1 year and 10-year bond, and from that I can compute like the secondary bond rate. It comes out to be approximately 5.7%. Okay. And I use the method which was mentioned by professor in the lectures, and like using this 2-year bond I can compute, this is the 2-year annualized rate, so I can compute the total holding rate of return for 2 years. That comes out to be approximately 11.72%, and I have 1 year holding period return. So from that I can compute this R12, which represent like if I the rate of return from year 1 to year 2, 1 year rate of return from year 1 to year 2. Okay. So that doing this calculation, that turns out to be like 5.80%. So if I purchase a 1 year bond next year on the same date, and if the economic conditions does not change, so it is kind of giving me a perspective regarding the future conditions, and I can make my investment decision based on that. So in that way we can use this yield curve to making a well informed decision for our investments.
Hello, sir.
Yeah.
Am I audible?
Yes.
Okay. Sir, usually government bonds will have a constant interest rate, right?
Yes.
So then, why do we want to know the interest rate for a year, or what is the use of yield curve?
So this gives me a, like these government bonds give me like the how stable is the economy as a whole is there, correct? So the change in these government bond rates are representative of the changing economic environment. So it gives me an overall idea like if these interest rates are rising, then this shows like there is more risk that is being there. That's why these interest rates are rising. So this give me this perspective, and which I can use like for making other decisions. This is how for evaluating the economic environment as a whole.
Okay.
So this is the simplest. This is one aspect. There may be other things which you may take under consideration while making your decision, but this is one way, one aspect which you may consider while taking these decisions, taking your decisions. Okay.
Okay.
And why this yield curve is important? Because this yield curve may represent like, so as I said, in normal times this yield curve is upward sloping. So if you simply observe the yield curve at a particular on a particular day, then you see like this yield curve is upward sloping, then you say like normal economic environment is there. And if you observe a inverted yield curve, that is one of the indication of like the adverse economic conditions. For example, this was the yield curve in United States in December 1980, and in 1980 like there was very high economic turmoil in United States, and that's why like this was in this inverted form. And you can have this hump yield curves also. So mainly this inverted yield curve is one of the key indication. But if you observe a hump also, then you see like there are short-term disruptions which are present there in the economy. So in long term, like the longer term perspectives are fine, but in short term there is very high fluctuations which are there in the economy. So this is one of the key indicator which you may use while making your decisions. Okay. So what now I will do is like I will show like how you can like, one second.
Okay.
Yeah, any questions if you have, like please do let me know. Okay, so that was the theory part. So how we can like do this yield curve analysis using the real data also. Okay, so today I will show you like how we can do this analysis using data from Fred, like which is the database on the United States securities. From that you can take. So I have prepared a Python script for that, and so using that Python script, so from that like I have used, if you have some like the coding knowledge also, so I am just demonstrating like how you can apply this knowledge on the real world data also. So from this Fred database, using their API, we can like export data from there and we can do our analysis over there. So here what I have done, I have extracted this yields data for multiple maturities, and in the United States this like the yields data is available for on a daily basis. Okay, for each day they provide these yields data. For example, so this is like on 3rd of January 2020, these are the yields values which are there. So for, and in United States there is 1 month treasury bills also available. So 1 month T-bill is this, 3 months, 6 months, 1 year, 2 year, 3 year. These are the different maturities at which government securities are issued, and these are the yields, like the annualized yields which are there. Okay, and I have extracted data like, for that like you have to use your key, and you can simply do a Google search like how to get your API key for Fred database. So it is very simple. Doing a simple Google search will do, and if you replace this area with your UPI, your API key, then this script will work for you also. Okay, so what I have done, I have extracted data from 1975 till last month, like to September 2025. Okay, I have extracted all the data, and for that like this is the overall, like I have plotted all the yields for all the maturities over the years. Okay, so here like you can observe an overall trend what is happening on the government securities yields. So you can see like near this 1980s there is very high yields, and when a government security is having high yields, it is representative of like there is some turmoil in that economy, or the government is unstable, etc., etc., because there is higher risk in that economy. So you see like in this period 1980s there was high risk period. Similarly, if you see this was this period, okay, period around 2007 when this global financial crisis happened. So prior to that there was normal condition, like the shorter maturities has lower yields and longer maturities had higher yields. But as the 2007 came, the global financial crisis came, all the yields were kind of like all the yields become similar, so the yield curve flattened. So that was one of the indicator, like yes, there is some disruptions in the market that is happening. And similar observation you can find near this 2020 in like during the COVID-19 times that you can observe. Okay, And like next I have done, like I have tried to plot this yield curve like for a particular date. So if you want to observe the data, for example, here I am plotting the yields, like I am plotting the yield curve for May 2011, which was given in our slides. So this was May 2011. So in this period, it says it is a normal. So you can observe like this is a normal yield curve, like upward sloping yield curve. Similarly, you can observe for in the 2007, which we said like it was almost flat. How it is flat, like you should also consider the x-axis, like I have not arranged the y-axis accordingly. So if you see, like there is very less variation in these yields. So there is very high variation, like yield is going from almost 0 to 4%, but here like the variation is from around 4.6% to 5.1%. So it is almost flat. If I change my y-axis values, then I will observe like it is almost flat. And you can also observe, like as it was said, like in December 1980, the yield curve was inverted, and it is a one of the indication of like the crisis happening in the economy. So that you can observe, and I will share this file with you also. Okay, and in like the COVID period also, like in March 2020, here also, like if you see the like the variation in the yields, you see like there is very small variation. So it is like when I will be sharing the final script, you if you run on your systems, you will like I will make the changes for the y-axis, so it should have it will show you like it is also a very flat yield curve during the COVID-19 period also. Okay, so this was like you can play with the data using that. For the Indian case, like there are systems are not yet very well developed for the Indian case, and for that, like normally whenever we do analysis on Indian data, what there is no APIs available, etc. So what we do, like we go to the databases, we extract data from there manually, and then we do this yield curve analysis. So for example, if I use this RBI database link, okay, so it will take me. So RBI nowadays provides a very wide range of data set, and you can find a lot of data there. So if you go to the statistics part, I think they provide, I forgot like which was the data. So in statistics, there are multiple so you can see like there are a lot of data is provided there, and you need to dig into this like the database, like which data is more relevant to you. Okay, so if you go to this key rates database, like the what are the different key rates related to Indian context, you will find them here. So I will let me see. Okay, so if you go to this RBI dataset and this time series publication, and there is a table will be called ratios and rates. So it will have some of the key ratios and different interest rates which are relevant for the Indian economy. So you may find some of the key rates, and I have taken those like 3 months, 6 months, 1 year, and 10-year bond rates from here only. Okay, I will show you. Yeah. So this is the weekly data that RBI provides. It provides some key ratios for the financial markets like case reserve ratios and all. So these are not relevant for us as of now. Yes, these these four columns I have shown to you, like 91-day treasury bill, 182, 364 days, and 10-year G cycle. I have used this data set for showing the yield curve analysis to you. Okay, and if we want to do the same analysis which we did for United States, for that, like nowadays, a like the website or platform which we call the CCIL, that is responsible for giving this data for the yields for different securities. So here you can find like this is the tenor bucket or the maturity which is there, and this is the yield to maturity which is given to you, and this CCIL nowadays give you the daily data. Like if you go and visit this website on a day, so for example today it is showing the yield for previous day like the 14th October. These were the yields which were there for different maturities. So if you want to this yield curve analysis for Indian, so for that you have to dig into this CCIL database or the RBI database provide you a data for limited maturities. So you can take data from here and you can observe these yields and do your analysis related to yield curves. Okay. So I just wanted you to show some databases which can be used to for your real world applications. Okay. Any other doubts or questions? If you have any material related to week 4, please do let me know. So the analysis like this Python demonstration or other databases, like this is for your general understanding. This is not for like for any exams or etc. So this is for a general understanding, like how these whatever we learn, how we can apply in our real world applications. And please do let me know, like if you want some such demonstrations for the future lectures, future weeks also. Please do let me know, like I will include them. Like in the future we will be having portfolio analysis also. So if you want some like the how we apply that into the real data, please do let me know, like I will incorporate that in the live week discussions.
Sir, good evening. This is Yoganandam.
Yeah.
I actually this is related to week 1 content only. I tried to plot in the similar way for the demand and supply related curve, which was shown in the week 1, no? The equilibrium price, how it is shifting when there is a event kind of thing. So the bid and ask details from real this thing from the markets, either from NSE website or something are there now. Last five bids will be there now. So that is a bid quantity and the bid rate is there. In fact, one question also available in the graded assignment. So that data I tried to plot, but I was unable to get in the same, not in the exactly means, at least even the shape is not coming. So if you could be able to help
So
me, please.
in week 1, I think the data
There was a curve, yeah.
Yeah, there was a demand and supply curve which shows like how this
Two
equilibrium
crosses will be there, yeah. Yes.
how we
Equilibrium will be shifted.
how we achieve to the equilibrium, correct?
Yeah. Yeah. Yes.
that is like that is happening very on a very fast basis in the real markets.
Yeah.
So because of that, we will not be able to observe like
So
those.
my intent was at least to see if there is a difference, or I wanted to take some example of such thing and then see how it applies in real world. Maybe we can take a data of 1 month horizon and see. That also I tried, but still I was unable to. Then I later third trial, what I've done was to see for any events. That is like okay, today Tata Motors this thing like that we can see. But then even then also the quantities
Yeah.
quantities are not uh, so much coming in the as per that trends in the slope. So where can we find some relation, or if not exactly the similar way, or
So one thing I would suggest you to like you can summarize your analysis in like in a some document kind of thing, and you can email me, and then I can have a look and like give you
okay,
comments.
okay,
Like that would be more easier to me to like first I
okay,
have to look
okay.
into it also like
Yeah, okay, okay.
what
I
is
will
it.
then I will make the documentation and then send it. Thank you.
Yeah, that
Okay,
that
okay.
would be better. Like first, like if I comment anything like without single.
Agreed. Because even I am also not expecting 100% it will follow match. But is there anything trials have you done something like that? I was asking. Okay,
Yeah, like I have
I will
to
send.
first have a look and then I will.
Okay, 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 sir. Thank you.
Sure. And also like in the last week's live session, I like at the end I ended with a question. Like the question was like the maximum price with you pay for, like what would be the maximum price that you would be willing to pay for a standard 8% level coupon bond and which pays semi-annually. So this is one of the questions like similar to the questions which are available in the Wealth book, which is one of the reference for this course. So, and this bond has 10 years of maturity and the prevailing discount rate is 10%. So what we do, like the bond has face value of 1000 rupees. It says it has a 8% coupon. So annually there would be 8% with like the coupon payment, and these are semi-annual. So we assume like same payments for like those 6 months payment. So total annual payment is $80. So these are semi-annual. So each 6 months you get 40 rupees, 40 rupees, and the annual discount rate is 10%. So semi-annual would be 5%. And using these interest rates, we simply compute the present value of all the future payments. So there will be $40 payments 20 times for 10 years, and we take discount that with 5% like the semi-annual interest rate, and the final payment which will be the face value at the end of 10 years like 26 months. So we discount that also, and we find the present value of the all the payments which I am getting through this bond to be $876.37. So this is the present value. So this will be the maximum price if you like if you know the finance, then this is the maximum price that you will be willing to pay for bond, given this condition. Okay. Yeah. Okay, great. Any other questions or suggestions? If you have, please let me know, or we can like we will be meeting next week then. Okay. And I wish you all a very happy festive season, happy Diwali to all of you in advance, and let's meet next week then.
Okay. Which ID I should send?
I will share that chat. So you can share it on the course email ID like this
MS3034. Okay.
that will work, or you can share it on my like institute email ID also. Like I will share it in the chat. So you can send me this email also.
Okay. Thank you. Okay.
Okay, then see you next week. And you can like, if you have any other doubts or any other particular things you want me to cover, like I think your quiz is scheduled next week, like the next weekend. So if you want me to cover any specific topics from these 4 weeks, please like notify me on the Google discussion form which we have, discussion group which we have. Okay.
So coming to quiz one, practicing this live session problems and DAP, will it be enough for?
Yeah, I think you should like, you should go through all the slides and practicing like the PYQs and the assignments. I think that will suffice. And if you want to have more practice, like as I said, like there are a lot of questions in the reference book which is suggested by the professor. And if you want some more, like please like do let me know. Like I will try to prepare over this weekend like some questions for you to
Yes,
practice.
so please, you can make some
Yeah,
problems.
I will try. Like that depends on like, yeah, I will try to make some time for that and I will prepare some questions. Okay.
Okay, sir. Okay, sir. Thank you.
And next week, do you want me to take a like revision kind of session, or do I continue with like the material of week 5, which would be better?
Revision session, sir, if it is possible, and
Yeah,
some
usually it
PYQs
will
also.
be.
Because in next week you all will also be like preparing for the. So I will try to make it a revision session. I will cover week 5 and 6 together in the next live session. Okay.
Oh,
Yeah. Okay. Okay. Thank you, everyone, and let's meet next week then.
thank you, sir. Happy
Thank you.
Diwali.
Thank you. Thank you. Thank you. Happy Diwali.